The ability to accurately anticipate the next major move in the market hinges entirely upon understanding the relationship between effort and result. This foundational principle, central to the methods of Richard Wyckoff, provides a roadmap for interpreting the hidden intentions of the large professional operators. Volume, representing the collective effort expended by these major players, must always be weighed against the resulting price movement, which is the spread of the bar. When these two elements align, the current trend is confirmed, but when they diverge, a profound shift in market dynamics is imminent and predictable. Wyckoff's second law is the law of effort versus result, and it is the key to unlocking market prediction. We define the volume as the effort expended by the supply and demand forces engaged in the market battle. The resulting change in price measured by the vertical movement or the spread of the bar is the result of that effort. If high effort, high volume, yields only a small result, narrow price spread, it signals that significant opposing force is entering the market, preparing to reverse the trend. Conversely, if low effort, low volume, produces a wide result, large price spread, it suggests that the path of least resistance has been established and the trend is currently running on momentum. The most powerful predictive indicator arises when large volume fails to produce the expected corresponding price movement. This failure demonstrates a massive absorption of shares by the opposing side, signaling that the existing trend is exhausted and a major change is now inevitable. Before we delve deeper into the specific phases of market manipulation and prediction, we must ensure this valuable content reaches everyone who needs it. Please take a quick moment right now to subscribe to the channel if you haven't already done so. Also, leave a short comment below, even if it is just a single word, to signal the algorithm that this detailed analysis matters. This simple action significantly helps this video get recommended to more serious traders and ensures that I continue producing this level of high-quality practical content. The predictive mechanism is governed by Wyckoff's third law, the law of cause and effect. This law states that every market movement or effect must have a proportional cause built up beforehand. The structure that serves as this cause is the trading range, whether it is a period of accumulation by strong hands or distribution by professionals. The duration and intensity of the trading range directly determine the magnitude of the subsequent major trend or the effect. A long, tightly contained trading range represents a large cause, implying that the resulting trend move will be correspondingly massive. During this range, the strong hands are systematically absorbing supply in accumulation or systematically offloading holdings in distribution. This phase is not random noise. It is a meticulously planned campaign designed to prepare the ground for the next significant market movement. Understanding this concept shifts the focus from chasing price movements to analyzing the structural preparation occurring within the range itself. The primary function of the trading range in accumulation is the absorption of supply, where professional operators methodically buy shares being sold by uninformed or panicked traders. In distribution, the function is the absorption of demand, where the professionals sell their large holdings into the excitement and fear of missing out experienced by the public. The analysis of volume and price within these ranges allows us to see this absorption process in real time, long before the ultimate breakout occurs. We are effectively looking for the footprints of the composite operator, the conceptual entity representing all large informed money. The first critical step in prediction is identifying Phase A, the action that stops the prior trend. This phase is marked by preliminary indicators that show the dominance of the previous trend is breaking down under extreme volume. These indicators are violent, high-volume events that signify a massive transfer of ownership. They are the initial signs that the cause is beginning to form. In a downtrend, the stopping action is heralded by the selling climax. This event is characterized by extremely high volume combined with a very wide price spread, often showing a dramatic drop and immediate rebound. This signature indicates massive panic selling by weak holders being aggressively met and absorbed by professional buyers. The sheer magnitude of the volume confirms that the selling pressure has reached an emotional and structural exhaustion point. In an uptrend, the corresponding stopping action is the buying climax. Here we see extremely high volume paired with a wide price spread as the market surges upward in a final burst of enthusiasm. This surge shows that professionals are taking advantage of public fear of missing out, selling their massive inventory into the hands of eager, uninformed buyers. The high volume confirms the professional unloading activity, signaling that the uptrend's fuel is being rapidly depleted. Following either climax, the market typically experiences an immediate, sharp price response known as the automatic rally in accumulation, or the automatic reaction in distribution. This move defines the initial boundary of the potential trading range that will serve as the cause. Crucially, the volume on this initial countermove often diminishes relative to the climax, which confirms that the initial dramatic stopping action was successful. The low volume suggests that the immediate pressure, whether selling or buying, has temporarily subsided, allowing the market to stabilize within the newly formed boundaries. Phase B is where the true predictive activity begins, as the market builds the necessary cause. This phase is characterized by price moving back and forth across the range, systematically testing the levels of supply and demand that remain. The duration of Phase B is crucial, as a longer Phase B means a greater cause is being established, promising a more significant effect later on. The composite operator uses this time to ensure the market is ripe for the intended markup or markdown. Within Phase B, the secondary test is perhaps the most crucial low-volume event for prediction. This test sees the price return to the area of the selling climax low or the buying climax high. The purpose of this test is to verify whether the supply or demand that fueled the climax has truly been absorbed. The successful identification of a secondary test relies entirely on the volume signature. In the context of accumulation, the price returns to the area of the selling climax, but the volume must be significantly lower than the climax volume. This low volume proves that the supply has been successfully absorbed by the strong hands during the initial panic. If volume were high on this test, it would indicate that new supply is entering the market, invalidating the prediction of an imminent uptrend because the downtrend has not truly stopped. The low volume confirms the market is now light on supply at that level. In distribution, the secondary test occurs when the price returns to the area of the buying climax high. Just as in accumulation, the volume signature is key, and it must be low volume on this test shows that demand is drying up, allowing the professional operators to continue selling without having to drive the price higher to attract new buyers. This lack of enthusiastic buying confirms that the market is ready for a markdown, as the composite operator can complete the distribution process efficiently. The analysis of these foundational elements, effort and result, cause and effect, and the volume signatures of Phase A and B, provides the bedrock for Wyckoffian prediction. However, mastering this framework requires more than just passive viewing. It demands active study of how these principles apply across various market conditions and asset classes. If you find yourself needing more structured guidance on applying these sophisticated strategies, you might benefit from exploring deeper resources focused on professional methods. Speaking of professional methods, if you want to see detailed strategies, analysis techniques, and the underlying principles employed by concrete traders, speculators, and investors, there is an excellent resource available. The Trading Insights channel focuses exclusively on breaking down the proven methods and principles used by successful market participants throughout history and today. Analyzing how others execute the Wyckoff principles in real time can significantly shorten your learning curve and provide the practical context you need. You can find the link to the Trading Insights channel directly in the description below, offering a focused study on market mastery. Now we move into the decisive part of the analysis. Phase C, the definitive tests that finalize the prediction. These maneuvers are designed to confirm the absorption process and shake out any remaining weak hands before the major trend begins. They are often manipulative actions that temporarily fool the majority of retail traders. To predict the upward major trend, we look for the definitive test known as the spring. The spring is a maneuver designed to achieve two goals: shake out the last remaining weak holders who have their stop-loss orders just below the support line, and provide a final, absolute test of supply below that critical level. It is essentially a trap set by the composite operator. The volume signature of a successful spring is the most crucial predictive element. The price must break decisively below the support line established by the selling climax and the automatic rally. But this penetration must be immediately reversed. Crucially, the volume on the penetration and immediate recovery must be low to moderate. Low volume confirms that the market is truly light on supply, meaning the strong hands successfully absorbed all available shares during the temporary dip. A failed spring, which invalidates the prediction of an uptrend, occurs if the penetration takes place on very high volume and the price fails to recover quickly. High volume during the penetration indicates that significant new supply is entering the market, overriding the absorption efforts of the professionals. Therefore, the low volume signature on the spring is the final piece of evidence proving that the cause, accumulation, is complete and the effect, markup, is imminent. Once the low volume spring confirms the market is ready, the prediction is solidified by the confirmation signal, the sign of strength. This is the moment when the composite operator begins to actively support the upward movement. The sign of strength is defined by the price breaking decisively above the resistance established throughout Phase B. The volume signature for the sign of strength must be high and expanding. This high volume confirms that the professional money is now actively participating and supporting the breakout, demonstrating genuine demand. This expanding volume validates the prediction made by the prior low-volume secondary test and the low-volume spring, showing that the market is transitioning from the cause phase into the high-momentum effect phase. The high volume confirms the commitment of the smart money to the markup. Moving to the prediction of the downward major trend, the definitive test is the upthrust. This maneuver is the mirror image of the spring and serves a similar manipulative purpose. The upthrust is designed to capture buyers who place their stops just above the resistance line and to entice new, uninformed buyers into the market, believing a genuine breakout is occurring. The volume signature for a successful upthrust is predictive because it reveals the lack of genuine underlying strength. The price thrusts above the resistance line established in Phase B, but the volume on this thrust should be moderate or low. Low volume indicates a lack of genuine demand supporting the move. It confirms that the movement is manipulative and engineered by the composite operator to liquidate their remaining holdings. The failure to maintain the thrust, signaled by the low volume and immediate reversal back into the trading range, confirms that supply is ready to dominate a particularly powerful final test, often occurring at the very end of a distribution range, is called the upthrust after distribution, or UTAD. This maneuver is a strong confirmation that the cause is complete and the prediction of a major markdown is highly probable. The confirmation signal for the downward trend is the sign of weakness. This is the decisive breakdown that signals the initiation of the markdown phase by the professional money. The sign of weakness occurs when the price breaks decisively below the support established throughout Phase B. This breakdown must be validated by the accompanying volume. The volume signature on the sign of weakness must be high and expanding. This high volume confirms that the professional money is actively initiating the markdown phase, selling aggressively into the market. This expanding volume validates the prediction made by the prior low-volume secondary test and the low-volume upthrust, signifying the transition from the manipulative cause phase to the high-momentum effect phase. High volume on the breakdown shows that supply has finally overwhelmed demand, confirming the predicted trend. The entire methodology relies on recognizing the shift in the balance of power, which is only visible through the lens of volume and price action. The ability to differentiate between genuine professional support and manipulative testing is the difference between successful and unsuccessful trading. Wyckoff provided a structured approach to decoding this market language, turning chaotic price action into a predictable sequence of events. The ultimate goal of this analysis is to identify precise, high-probability entry points based on volume confirmation. For accumulation, the best entry points are often found after the low-volume secondary test, confirming supply absorption, or upon the successful high-volume sign of strength, confirming professional commitment. Entering after the sign of strength provides greater certainty, although it often means missing the absolute bottom of the range. In distribution, strong entry points for a short position are similarly found after the low-volume upthrust, confirming the lack of genuine demand, or upon the high-volume sign of weakness, confirming the professional initiation of the markdown. Waiting for the sign of weakness offers the highest confirmation, ensuring that the market has committed to the downward path. These entries are predicated on the validated prediction that the trading range's cause is now ready to produce its effect. The predictive power of the Wyckoff method does not end once the trend has started. It continues throughout the ride, helping traders maintain confidence and identify potential exhaustion. During the predicted upward trend, confirmation is maintained if the price continues rising on expanding volume and any temporary reactions or pullbacks occur on diminishing volume. Expanding volume on the direction of the trend shows continued professional support, while diminishing volume on reactions shows a lack of serious selling pressure. Conversely, during a predicted downward trend, confirmation is maintained if the price continues falling on expanding volume and any temporary rallies occur on diminishing volume. Expanding volume confirms continued aggressive selling, and diminishing volume on rallies confirms a lack of genuine buying interest. These volume signatures assure the trader that the predicted effect is still in force, and the major trend remains intact. The final warning sign, bringing us back to the law of effort versus result, occurs when the predicted trend stalls. If the market is moving upward or downward, but wide volume begins to appear without producing corresponding price progress, the major trend is likely exhausting. This divergence signals that significant opposing absorption is entering the market, supply in an uptrend or demand in a downtrend. When effort fails to yield result during a trending move, it is the first indication that the composite operator is preparing for the next trading range, either reaccumulating or redistributing their holdings. This divergence serves as the crucial signal to take profits and prepare for the next cause phase. The continuous monitoring of volume and price ensures that the trader remains aligned with the intentions of the powerful market players. The entire methodology of Richard Wyckoff is designed to remove emotional decision-making by providing concrete, observable criteria for predicting market movements. It teaches the trader to read the market as a narrative of supply and demand, where volume is the voice of the professionals. By mastering the sequence of the phases and the critical volume signatures, especially the low-volume tests and the high-volume confirmations, you gain a measurable edge. We have covered the foundational laws, the critical volume signatures of the stopping action, the low-volume tests of Phase B, and the definitive high-volume confirmations of the spring, upthrust, sign of strength, and sign of weakness. These tools allow you to transition from reacting to the market to anticipating its major turns. Utilizing this detailed framework ensures that your trading decisions are based on structural evidence rather than mere speculation or fleeting news events. This structured approach to market analysis, focusing on the underlying mechanics of professional operations, has stood the test of time. It provides a robust method for understanding the ebb and flow of capital that drives all major market shifts. By applying the law of effort versus result and the law of cause and effect, you are equipped with the predictive tools necessary for long-term success. For those dedicated to mastering these methods and seeking the original, time-tested wisdom behind this analysis, there is one essential resource. Richard Wyckoff himself compiled his lifetime of trading experience into a foundational text that provides the deepest understanding of these principles and their practical application. This work explains in detail how he traded and invested using these methods. The book, How I Trade and Invest in Stocks and Bonds, is an adapted edition of Wyckoff's classic work, tailored for the modern trader while retaining the purity of his original insights. It meticulously reveals his proven step-by-step methods for analyzing the market, identifying the intentions of the large players, and making informed, reasoned trading decisions. If you are serious about integrating Wyckoff's techniques into your strategy, this book is the definitive guide to implementing the principles we have discussed today. You can find the link to this indispensable resource how I trade and invest in stocks and bonds, in the description below, allowing you to continue your journey toward professional level market prediction.